My name is Patrick Adams, and I want to talk to you today about what loss-averse investing is. It's an investment philosophy that myself and my firm created about 20 years ago. It was out of necessity back in 2001. The markets were very risky, and we thought that we had to put in some protection for our clients so they wouldn't lose a lot of money in a very big bear market. The philosophy is centered around it's great to make money in bull markets, but we hate to lose money in bear markets. Nothing you can do about losing a little bit of money when the market starts to roll over, but you lose 50%. That hurts. That takes a long time to make that money back up. As everybody knows, if you lose 50%, you need to make 100% to get back just to being even. The loss averse investing philosophy, it's built around protection of your portfolio when you need it. How do you protect the portfolio? You do it by applying a hedge in the portfolio. Now, there's a lot of inverse ETFs out there these days that allow you to protect your portfolio very quickly, very easily. You can just simply buy the inverse ETF on the S&P 500 to protect your downside. We developed a tactical algorithm many years ago and think it works really well. Essentially, when the markets start to roll over, you'll start to break certain moving averages. As it breaks certain moving averages, you want to become more defensive. As you finally get maybe down to the 200-day moving average, or if you start quite a bit of distance away from the 200-day moving average and you're not comfortable with that sort of risk, you can start earlier, say the 100-day moving average. But as you start to break these moving averages, you want to become incrementally more defensive, and below the 200-day moving average, you just want to get out of the way of it. So I'm going to show you how to do this on your own, but a little bit more detail about this. The beta of the portfolio, it's a common term in finance. It's volatility versus the overall market. Our volatility versus the overall market can range from, say, 1 equal to the market all the way to 0. So a beta of 0. And so why we do that is as we're going in an upward move in the markets, we want a beta of 1 or more somewhere around that range. But when the markets are falling, we want a beta of 0. So we don't want to go down with the overall markets. And that's how the hedging comes in place. The hedging takes the beta or protects the portfolio in a bear market. I want to talk to you a little bit about traditional asset management. Back when interest rates were high, you could use a traditional asset allocation to protect your portfolio. It's common to use what's called a 60-40 allocation, when you have 60% of your money in stocks and 40% in bonds. So as your stocks decline, your bonds will protect you. Maybe they kick off a 6 or 8% sort of return. And if your stocks fall 30%, well, you lose a little bit of money, but it's not the end of the world, right? Nowadays, with interest rates so low, 4% or 3% on a bond, it doesn't really provide the same protection as a 6 or 8 or 10% bond typically would. That's the main reason you want to protect the part of the portfolio that's at risk, because if you're in a 60-40 portfolio, that may or may not work. So protecting the part of the portfolio that will fall, say 30 or 50%, is paramount to having good long-term returns, compounding your money at an attractive rate. And I'm going to give you some examples. Say we're in 2008 and the market falls 50% from the high to ultimately the low. To come back out of that, you have to make one heck of a return to get back to even. What our strategy does is allows you to protect your portfolio, and as you come back out of it again, you get the benefit of the rise, but not the decline. You're probably wondering, what about the tax issues? What I like about our philosophy is that part of the portfolio, 50%, stays in the portfolio at all times. So if you own the S&P 500 ETFs, you can ride those for 30 years on half the portfolio. But there's sometimes when you want to reduce your 100% exposure down to 50% to protect the downside. So half the portfolio will never be taxed, but the other half will come in and out as appropriate. You can use this philosophy on any sort of asset. If you have gold, or if you're in the NASDAQ, the Russell 2000, or you have various different holdings in your portfolio, like our loss averse equity income portfolio that has blue chip companies and higher dividend paying stocks, you can do this with. You can collect your 5% yield on your portfolio and then protect the downside when you need it. As I mentioned, we created this philosophy in 2001. 2002, the full year, the S&P 500 was down roughly 22.5%. So if you put $1 million into the market in 2002, you would have ended up with $775,000. That's important if you're a retiree or if you're somebody that likes their money. You don't want to lose $225,000. The PVG strategy would have, by contrasting, would have been up to $1.1 million. So one way, buy and hold, $775,000. Our way, $1.1 million. That's a big difference. Okay, let's look at 2008. Again, same portfolio, actual returns. $1 million turns into $625,000 if you just own the S&P 500, and that's only '08. Our returns, you have a slightly positive return, you get to about $1,017,000. So you're up almost 2%. That's pretty good. So when you come back out of it, if you look at over a 5-year period, it takes the S&P 500 5 years from the start of the bear market in '07 to being roughly flat by the end of 2012. So 5 years of down, up to finally get back to even. The PVG loss averse equity income strategy, it took from the start of the bear market to 5 years later, it was up 60%. So if you think about your retirement assets, or if you like to take a more aggressive portfolio and limit the downside and get bigger returns on the upside, loss averse investing is a very effective way of doing that. I want to show you in a very simple way how you can do it yourself. Through here, you just have to rough it out. We like to start earlier with the 50 or the 100-day moving average if you're a significant distance above the 200-day. And if you want to do a really simple approach, this will work really well. It'll save you a lot of money through a bear market. As you meander your way up and down the markets, you may lose a little bit of money because of the volatility, but it's nothing great. As you finally break that 200-day moving average, the line in purple, you do not recover. You continue to go down from 4,500 to roughly 3,600 on the S&P 500. That's a large decline, roughly 20% loss in your assets over that period of time. If you would have followed this simple rule, it's not fundamental. You don't have to be a genius about the economy. You just follow this simple rule. Get me out when it breaks the 200-day and get back in once it breaks above the 200-day. You can see a lot of little lines here. I want to explain this to you. The yellow line is the 100-day moving average. The green line is the 50-day moving average. The red line is the 20-day moving average. And then you have some support levels. What the market has done is it's broken through all these moving averages, all these support levels. Now today we're at the end of September. We're slightly below the very last support level before there's another significant break. If the market would recover and start to break some of these moving averages on the upside, we would then incrementally get back invested in the markets. If you want to do this yourself, it's a full-time job. You can do it. Just use the 200-day or use our rule of 3, using 3 different moving averages. Incrementally get out like a dimmer switch, and then incrementally get back in as you brighten back up the room. It's kind of funny. There's probably a good reason why I'm not an actor, right? But I'm a good money manager, and there's probably nothing more important for your money than loss-averse investing. Please hit like, please hit subscribe, and we'll talk again in the future.